Q1FY25 earnings conference call hosted by JM Financial. As a reminder, all participant line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Bhise. Thank you, and over to you, sir.
Good morning, everyone, and welcome to the 5-Star Business Finance Limited's 1QFY25 earnings conference call. First of all, I would like to thank the management of 5-Star Business Finance for giving us the opportunity to host this call. From the management side, we have Mr. Lakshmipathy Deendayalan, Chairman and Managing Director, Mr. Rangarajan Krishnan, Chief Executive Officer, and Mr. Shrikant Gopal Krishnan, Chief Financial Officer of the company. As always, we will have opening comments from the management, post which we will open the floor for Q&A. With that, I would now like to hand over to Mr. Lakshmipathy Deendayalan for his opening comments. Over to you, sir.
Thank you, Samir. Good morning. I welcome everyone for this Q1 earnings call for the financial year 24-25. This is our 8th earnings call. You have seen us in last 8 quarters of performance, what we say and what we do, and what we have delivered in last 2 full cycles. Before getting into the numbers of June quarter, let me give you some highlights. Generally, June quarter is a muted quarter for all lenders. For 5-Star, we have done extremely well and did highest ever numbers in this quarter. To highlight a few, I'm happy to say that our asset under management has crossed 10,000 crores in June quarter. Very emotional, being the chairman and managing director of 5-Star. When I joined 20 years back, we were at 10 crores. Today, when I look back and see the growth, what we have done in last 2 decades, we have reached at 10,000 crores, which is 1,000 times in last 20 years. Thank you for all the support that shareholders you have been giving to me and the management team to run it in a steady and a stable way. Second highlight is our profitability, which has crossed 252 crores in June quarter, which is our ever highest quarter of PAT recorded in the history of 5-Star. Third highlight, our ROE, which is the return on equity, which is a very important metric for a shareholder, is at all-time high of 18.95% in a quarter, and we will comfortably cross 19% for the full year. So with this positive highlights, what we have done in June quarter, let me get into the numbers. Starting from branches, we have opened 27 branches in June quarter, which keeps our total branch strength at 547 branches. Disbursement, which saw 1,318 crores in June quarter, comparing to 1,336 crores in March quarter, which is almost flat. It is a good sign when a lender was able to deliver the disbursement equal to the best quarter of March. That gives a very good kickoff for this full financial year. When we compare with June of last year, we did a disbursement of 1,132 crores, which is 16% higher than year on year. That has reflected in increase in our AUM. As I said, we have crossed 10,000 crores. We are at 10,344 crores as of June end, versus 7,583 crore in last June, registering a 36% year-on-year growth. and from March, 9,641 crores, registering a 7% growth on Q-on-Q. Now, taking you to the collections, which is the most important part. Our collection efficiency in June was a bit lower comparing with March. That's the usual effect of June quarter. Adding to that was the election heat and heat wave across entire country that had an impact on the collection efficiency. Nevertheless, it was only a small blip. We were at 99.5% in March. We are at 98.5% in June. The unique customer collection efficiency, which we normally call collecting a due from a live customer, was almost equal with March. It was at 97.8% in March versus 97.2% in June. So that shows the slowdown is very, very small. This has reflected in gross stage 3 assets, moving from 1.38% in March to 1.41% in June, a small blip increase of 3 bits. Whereas it was stable comparing with last June, it was 1.41 versus 1.41 in this June too. Now, moving towards the cost of funds, our cost of funds on book was 9.6% in June quarter, which was same in March quarter as well. But the good news is the incremental cost of borrowing is coming down from 9.58% in March to 9.47% in June. So this shows the interest from lenders' perspective and the risk premium, what 5-star was added to 5-star is coming down. The increase in AUM and good collections has resulted in one of the good profitability for 5-star. Our total income has gone up to 669 crores in June quarter comparing to 483 crores last June year-on-year, registering a 38% year-on-year growth. And from March, it moved up to 619 crores to 669 crores, which is a growth of 8%. Translating into good profit, as I said earlier, highest ever profit that we have made in a single quarter. We have done 252 crores of PAT comparing to 236 crores in March and 134 crores in June last year, registering a 37% year-on-year growth and 7% Q-on-Q growth. And finally, moving towards the returns, the return on assets is stable at above 8% comparing to March. And as I said, the return on equity is an all-time high at 18.95 comparing to 18.65% in March quarter. And as I commented earlier, we'll be comfortably crossing 19% plus for the full year in this financial year. So with these numbers, I will hand over to Srikanth, our CFO, to give detailed commentaries on all the numbers.
Good morning to all of you. As Mr. Pati said, this is a very, very memorable quarter for us. We crossed the 10,000 crore mark in our AUM. So this is a progress that has been built over the last many years, and it's a moment of real joy for all of us. I'll touch upon some aspects which Mr. Pati has not covered. I don't want to repeat whatever he has already stated. Our active loans has gone up from about, it has gone up to about 4.1 lakhs, which is a 29% growth on a year-on-year basis. This clearly shows that the growth is still led by increase in borrower base rather than increase in ticket size. The ticket size remains almost flat at about 3.5 lakhs. Our yields continue to remain consistent at around the 24 quarter percentage. The cost of funds is at 9.65%. So the spreads are flat as compared to the previous quarter and similar to June 23 as well. There is a compression in NIMs on account of increased debt and increased leverage. The NIMs dropped to 16.72% as against 17.74% in the quarter one of last financial year. Our cost to income continues to be very attractive. Inclusive of credit costs, this number was at about 34.34% for this quarter as compared to 36.6% for the June quarter of last year. Again, as we have guided in the past, we expect our cost to income to be around 35-36% levels in a steady state scenario. So there is not a very great room available for continuous reductions in the quarters to come. This has resulted in an ROA of about 8.23% for the quarter and a return on equity of 18.95%, very close to 19%. From a borrowing perspective, we have about 42 lenders who have lent to us. One other encouraging fact, in line with our stated strategy, we have started the process of diversification of our borrowings. Our borrowings from banks, the proportion of borrowings from banks reduced from 79% in March to about 24% as of now. If you compare on a year-on-year basis, it has dropped from 84% to 74%. During this quarter, we received incremental sanctions of about 850 crores. We availed 825 crores at an all-inclusive cost of 9.47%. The company continues to be conservative in terms of maintaining good liquidity buffers and unavailed sanction lines. So we had a liquidity buffer of about close to 1,900 crores, 1,891 crores, and unavailed sanction line of about 400 crores. We will also see more non-bank capital market transactions and DFIs getting added in this quarter and the quarters to come. We have seen a marginal dip in the collection efficiency. Mr. Pati has already talked about that. But for those marginal increases, which has also impacted the current and the delinquency bucket a little bit. From a provision coverage perspective, we are still very healthy and robust. We have a stage 3 provision coverage of 52% and an overall provision coverage of 1.63%. So we will continue to remain optimistic as well as cautious. We will maintain a good level of provision buffer to protect us against any unforeseen risks. One of the other encouraging facts during this quarter is the penetration of digital payments. If you recall, we had highlighted in the last earnings call that we will end this year with about 70% non-cash and 30% cash payments. We were at about 57, 43 as of last quarter. But this quarter, we have actually made a very significant improvement on that. We are at about 65% of non-cash payments and 35% of cash payments. So to achieve the number of 70-30 that we had guided you seems a very, very comfortable position for us. At this point of time, we don't want to revisit our guidance, but the 70-30 is extremely achievable for us. So that is another positive that we have achieved during this quarter. So given all of these things, we had one of the best quarters in terms of profit after tax at 252 crores. A growth of 37% year-on-year and 7% on a sequential quarter-on-quarter basis. Our net worth stands at about close to 5,500 crores. It's at 5,450 crores. So again, we have demonstrated good performance across profitability, quality and growth, which will continue in the quarters to come. With these opening remarks, we'll open out for any questions that any of you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mahrukh Adajania from Nuvama Capital. Please go ahead.
Hello, congratulations on the results and on the 10,000 crore mark. I just had a couple of questions. Firstly, on your liquidity. So now, do you see yourself maintaining such excess liquidity for a long period of time? Because I guess the liquidity buffer has kind of increased over the last 3-4 quarters, right? As in the level of liquidity buffer. Would that continue for some more time? And then the other question is that there's varied feedback from lenders on how heat wave has impacted collections. Yours don't seem to be impacted in any big way. So any comments you would offer on how you could have good collections in an otherwise bad quarter?
Yeah.
For others. Sorry, that's what I'm saying.
Yeah, thank you, Maruk. Let me take up the second question, then Srikanth will come in for the first question. Yeah, Maruk, it was a tough quarter for all lenders. Generally, after pulling back everything from customers in March, generally there will be a muted quarter for June. Let it be banks or non-banks, the trend is same. But what happened in this June was prolonged elections and prolonged heat wave had an impact on the cash flows of the customers. Adding to it, the June was the school season, so people have to pay their kids' school fees. So there were 3 challenges for every lender. I'm not talking about 5-star. For each and every lender at retail level, where they have 1 or 2 loans to repay, it was not an easy for the customers to repay the EMIs on time. But as I said, we have a very strong collection infrastructure at the ground level. This helps during these kind of things, and we are able to monitor this very well because we know that May and June is going to be the difficult one. So we had a good collection strategy put in place in May and June. That has really given a good effect. There was a small blip, as I said in the opening remarks, from the collection efficiency, and you see DPD, there's a small dip in each of the buckets. That will get corrected in due course of time. So I can even give you the update of July, which closed yesterday. It gives an encouraging sign, and it is better than the June month collections. We have to wait and see how August and September turns out for 5-star. But yes, because of expected one and because of strategy put in place, our impact was a bit lesser compared to other lenders. Yes, I also saw other lenders' numbers. 5-star is fortunate to have lesser impact comparing to them.
So Maruf, on your question on the liquidity buffer that we are maintaining, our intention is to maintain around 15 to 17% of our AUM in the form of liquidity. This is broadly the thumb rule that even bigger NBFCs are actually following. And we would like to maintain it about 15 to 17%. We are probably 1 to 2% higher than that. But if you look at from a trajectory perspective, this number has been coming down. We were at about 20% of our AUM that we had as liquidity in December. That has actually dropped to about 18% as we speak. See, it is not a question of the fact that we want to have a higher liquidity buffer. It is also a question of the kind of sanctions that we get. What are the sanctions that can be accommodated, and what are the sanctions that can be, pushed out a little bit. So there is a little bit of balancing act that we play on this. But we will definitely ensure that we maintain about 15 to 17% liquidity, and a percentage of or 2 higher will be because of specific names that we have been looking at onboarding. If they come in, like for example, IFC could not have been branched out, but we needed IFC, and hence we had to take the entire 500 crores. There are still 400 crores of undrawn sanctions that we have as we speak. So it's a balancing act that we do, but about 15-17% is what we would like to maintain in a steady state scenario.
Okay, thanks a lot. Thank you.
Thank you very much. The next question is from the line of Raghav Garg from Ambit Capital. Please go ahead.
Hey, hi. Thanks for the opportunity. I have a few questions. So one is, on the business officers side, I see that the addition to business officers is nearly flat this quarter, whereas, in the last several quarters, you seem to have beefed it up. So what's the thought process here behind no addition of of these officers? Is it that you hired a lot in the last 4, 5, 6 quarters and you want to utilize that capacity first? That's my first question.
So Raghav, in the last earnings call, we explained to all of you that the strategy from a branch expansion perspective is divided into 2 parts. One part is what we call as a split branch or a cluster approach, wherein one bigger branch is getting broken, and it is from the bigger branch we're opening another new branch. So when this happens, there is a set of officers who get transferred from an existing branch to the newly opened split branch. So this constituted about 50% of the branch openings last year, and the balance 50% is all completely branches that have started from the scratch. So if you look at in the first quarter of this year, we opened about 27 branches. Again, the split is very similar. So wherein a number of new branches have been opened, which is just split from an existing previously big branch. And when this happens, officers get transferred from the bigger branch to the newly opened smaller branches. So it's not a linear addition of officers with respect to the branch openings. This is what is also giving us the leg up in terms of little bit of lower operational costs that you can see reflected in our financials.
Understood. And that is why it's leading to, say, higher number of accounts being handled per employee. Is that right? Just the segregation of branches, in terms of new branches and the cluster expansion.
Correct.
Understood. And just out of the 27 branches that you...
Just to clarify it further, it is not higher number of accounts given to an officer. Where an officer had a lower number of accounts, it has been adjusted in last quarter.
Okay, sure. Understood on that part. Just out of that 27, how much of that would have been because of the cluster expansion, and how much of those branches are completely new?
So roughly it is 50-50.
Okay. Understood.
Yeah.
Sure. And just one last question on, in terms of the number of loan accounts or loans disbursed. The growth is about 11%. There is quite a bit of moderation. Where do you see this number in terms of growth for FY25 and, on a sustainable basis for, say, next 3-4 years?
Raghav, are you talking about the AUM growth?
No, I'm talking about the number of new loans disbursed in this quarter.
Number of new loans disbursed. See, the point that we are saying is that is linked to the overall disbursal quantum that we are looking at. So, for example, between last year and this year, our disbursals are expected to go up by about 25 to 27%. And with a little bit of push-up in the ticket size, which will come because of inflationary increases, you will probably see the number of loans growth by about 20 to 22% rather than getting to 25-27% kind of a number. So I would say broadly anywhere around 18 to 20% is the number of loans that will keep going up on that will be the disbursal number on a quarter-on-quarter basis.
So Raghav, there are 3 things for the growth to kick in for 5-star. The first one is the branch addition. I restate that even in this year, we'll be adding close to 80-90 new branches and close to 100 split branches. So the numbers will be close to 200 branch count. Whereas new branches will be 80 to 90, and the rest will be the split branches, as Ranga explained, to handle the risk better. That's the first lever. The second lever is addition of officers. That will also be done in this year. Third is increase in ticket size. We have been doing it at 3.5. This year it will be close to 4. So all 3 levers put together, I'm very confident that we'll be growing at 30% plus for the full financial year.
Understood. That's helpful. Thanks a lot. That's all from my side.
Yeah, thank you, Raj.
Thank you. The next question is from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Yeah, hi sir, and congrats on a good set of numbers. So just 2 things. One on the disbursement growth run rate side, which has been falling since Q2, which has been now decelerated to 16% YOY. I can understand that it's a seasonally, but still, and hence we are looking at the YOY growth and not the sequential growth. And also, when I look at the disbursement per branch on a 2-quarter like basis, just to eliminate the impact of new branch opening, that run rate is now fallen to 2.7 crore in Q1FY25 from the peak of 3 crore in FY24. So how one should read this data? I mean, a fall in disbursement per branch, also deceleration in disbursement growth rate.
Yeah, Ramesh, let me clarify to all shareholders who are there in the call. Don't go run rate per branch for next at least for 18 months, because as Ranga said, there is a clear-cut strategy for 5-star to make all super branches into split branches and bring the number of officers, which were close to 15 officers in a branch, close to 8 officers in a branch. That addresses a lot of risk, and that also spreads our wings across the geographies wherever we are present. So you have to only look at the AUM growth metric for at least next 3 to 4 quarters, because if you go by branch count, it will be looking like as if the business done in a branch is come down. It's not like that. For example, if a super branch would have been done 2 crores business in a month, when the super branch is being split into 2 ideal branches, the run rate still be at 1.25, but it will be read as 1.25 per branch. So that's not the right metric. It's what I think Ranga and Shrikant can clarify on that too. But you have to see the AUM growth on quarter, year on year, where 5-star wants to put up. That's what I gave the commitment that even for this financial year, there is no change in our guidance. We will be at 30% plus growth for the full year. For the first quarter, we have grown more than 7%, and we'll be comfortably crossing 30% for this full year. And yes, June being a seasonal one, and we have pulled out a lot of business in March month, there will be a slight drop in the June month, which will get corrected in the September, December, March months. That's how every lender will look at that annual growth.
No, sir. My question is more on the disbursement growth side, right? I mean, it has been running at some 40-50% YOY growth, then it fell to 33% in Q3, then it fell to 20% in Q4, and now it is at 16%. So I can totally understand, the branch metrics which you just highlighted, but then deceleration in disbursement growth rate, what explains that there is a deceleration?
Yes, Ramesh, the disbursement slowdown is here to stay, not only for 5-star, for every lender in this country. You'll see the slowdown in disbursement. It's not because of the opportunity is coming down. We have to also take into account what is the regulatory thought process and what is the regulatory commentary which we are hearing on a day-to-day and a quarter-on-quarter basis. So we should also be mindful of that. I said in the last quarter itself, let the dust all get settled. Let our asset quality speak for ourselves. I think then the growth will be back on the same numbers what you have been referring to.
So, Ramesh, it is also a question of a little bit of muted disbursements during COVID. So if you're comparing, let us say, 22 to 23, where the disbursement number was much higher, it is not because 23 was significantly higher. It was because 22 was muted. And 24 saw, some bit of a pent-up demand as well. So you will see some moderation happening. I think those two are a little bit of years where you had some aberrations because of the base effect. But otherwise, like I said, if we are looking at a 32% kind of a growth on our AUM, the disbursement growth will be more around 25 to 27%, because there will be some bit of ticket size increases, and we are lending for a 7-year tenor. So it won't go tandem hand to hand with the AUM growth. There will be about 4-5 percentage points difference between the AUM growth and the disbursement growth.
Got it. In fact, my last question was on this repayment rate side, right? So, we have been always highlighting that our behavioral tenure for loans is 7 years, right? But when we look at the repayment rate, it is hovering around 22 to 25%, which means the behavioral tenure is much less. I mean, of course, including prepayments, BT out, etc. And when we look at last 3 quarters, it is actually turns out to be some 7% sequentially, which is on an annualized basis, upwards of 25%. So how one should look at the actual tenure of your loans? Because then eventually it will start impacting the growth, if disbursement doesn't come.
So you're right. I think one point that I want to correct in what you said is, we always say that the origination tenor is about 6 to 6.5 years, while the behavior tenor is more like 4.5 years. So you're right to the extent that you will see about 20 to 23%, 22 to 23% kind of run rate, runoff every year, which will translate roughly to about 4.5 years of behavioral tenor. So I think that's a number that's broadly remained range bound for the last 4-5 years. And we don't see that number significantly changing in the coming years as well. So there will be normal repayments and there will be some level of prepayments, which has also largely remained range bound between 9 to 12% on a year-on-year basis.
Got it. And so just last question, if I may. So what is the reason for moderation in credit costs, which is again a reflection of falling stage 2, stage 3 provision, despite of the fact that collection and 1+ DPD is up sequentially?
So, Ramesh, I think we have been building this credit cost over the last couple of years, and it sort of has reached a stage where we are comfortable with these numbers. So if you look at the PDs and LGDs, if we don't build some overlays, our PDs and LGDs will result in a credit cost that will be much lower than the ECL provision that we are carrying today. So our thought process is, there is something that gets thrown by the model. There are specific overlay factors that we use to build the management overlays on ECL, and we are comfortable around the number that we are carrying. So it is not a question of the credit cost decreasing because we wanted to decrease it. It is a question of the model and the factors that we use for overlays, which gives us a number, and we are comfortable around that number. I said, the stage 2 question of around.
I just wanted to reconfirm that we have not changed PD LGDs. It is might be a little lower overlay this quarter, might have led to the sequential decline rate. I mean, is that the fair conclusion?
PDs and LGDs are getting a little better. For example, last year you saw the current proportion going up significantly from about 83% to 87%. So that obviously brings down the PDs. And the fact that we are able to recover well is also reflecting on a lower LGD. So there is some improvement in PDs and LGDs as we keep increasing and it is also a question of using the last 5 years data, right? So you have the earlier quarters going out and the later quarters coming in. 5 years back, our DPDs were not as good as this. So you will always see improvement in PDs and LGDs, but we sort of ensure that we build some management overlays. So to get to a number that the company, the board, the management and the auditors feel comfortable with.
Got it, sir. This is very helpful, sir. Thank you and best of luck, sir.
Yeah, thank you.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you and good morning, everyone. So congratulations on again a good quarter and crossing that important milestone of 10,000 crores in AUM. So first things first, wanted to understand this very good improvement in cash proportion in collections, which has declined to 35% now. For the full year, you're still guiding for cash collections to decline to 30%. Just trying to understand what are those efforts that have gone into this to kind of get here. Because like you'll recall, right, this was also something which was very widely debated, cash proportion being high in the past. Sometime last year, this used to be as high as 60%. So just trying to understand what changes have you done, and I mean, do you now expect these things to be permanent and structural in terms of changing employee, in terms of changing customer behavior?
So Abhijit, over the last 2 years, I would say that we have consistently been increasing the modes in which the customer can make a payment, and most of it that we have introduced is all digital modes of payment. So we first introduced a payment app wherein the customer can log into the app and then make a payment at any point of time. We have a tie-up with Razorpay for this, so a customer can make a app payment or a payment through our website. But I think the next big game changer started for us when we tied up with the BBPS. So today a customer can log into any of the popular BBPS apps, which is Google Pay or Phone Pay, and then make a payment to us through the UPI. And I think that's a very big game changer for us. I think the next strategy that we introduced is that every passbook that we give to the customer, we started printing that with a very specific QR code, wherein the customer can directly just scan the QR code and make a very specific payment to his account at the convenience of sitting from his home. This we started from January. And I think from May this year, we have started another big thing, which is for all fresh payments, fresh disbursements that we make starting from the month of May, the UPI auto pay sign up is mandatory for the customer. So which means unless the UPI auto pay is set up prior to the disbursement, we will not make the disbursement. Earlier this used to be an offline process, and there's a lot of translation errors between the time that you make a disbursement and actually the NACH mandate getting set up. Because there could be a number of reasons, like it's an inoperative account or it's a signature mismatch, or any number of reasons where the customer can find excuses of not signing up for a NACH mandate post a disbursement. But when you make that as a compulsory precondition prior to the disbursement, we have seen huge uptick on that. And today, for 100% of the cases that is happening. But it's not necessary that 100% of the customers will still make a UPI payment. But I think, the effort is everybody signs up. Very few number of customers may not have the monies in their UPI account and on the time of the repayment date. They can always come back and pay through any other means or any other digital means. But at least the effort of the company side is very clear that unless you have an UPI, unless you do an auto UPI mandate with us prior to the disbursement, we will not be able to disburse. So I think these are clear structural changes that we have made it on the ground, and more customers are adopting for it. We have guided in the beginning of the year that we will be at about 70% digital payments, and I'm fairly confident that we should cross that number comfortably.
So just to add one point, and even from the customer's behavioral aspect, there's a quite good bit of change that we were able to see. We were not able to get it right 2 years before. We thought the cash still is the king at the ground level, but a lot of change has happened in last 2 years. And when we approached whatever Ranga said in last 24 months, that is yielding as a much faster effect rather than a slower one. So we are very confident that except the little rural market, people still wanted to pay by cash. In semi-urban and fast-growing rural market, people adoption in digital payments are much higher, and encouraging to see that our people are able to convince the customers and move towards that. So all put together, I think we are good to go with 70s to 30 and revisit after the March where we can take the 70 numbers to.
Got it, sir. This is useful. So, effectively speaking now, from March onwards, all disbursements that we will be doing will have a precondition of an UPI auto pay.
Yeah, Abhijit, from May onwards.
Yeah, from May onwards, sir. Sir, the second question I had was for Srikanth, sir. So given, yesterday's Fed meeting and the fact that there are now rate cuts which are there on the horizon, given that we still have almost 75% of our borrowings coming from banks, you could just elaborate how have we kind of positioned ourselves on that side in terms of fixed to floating, or for that matter, a 3-month or a 6-month MCLR. How are we positioned, and how can we benefit from any rate cuts? That's it.
So, Vijit, our breakup, in fact, we had given this in our presentation, our breakup between fixed and floating today, we are at about 65% floating and 35% fixed. It went up a little bit because of the NCD issuance that we did to IFC. So, which is why the floating is at 65%. And given the fact that we are also moving slightly away from our strategy of borrowing from banks, the floating will be a little lesser because the rest of the facilities typically tend to be fixed, especially on securitizations and all that. On the floating, if we look at the breakup of this, the floating proportion, We have about 70% of that which is linked to MCLR and about 30% which are linked to the external benchmark rate. And even on the external benchmark rate, most of it, 75% of the EBR linked facilities are linked to repo. So very clearly, if there is a benefit that is going to come through the rate cuts, we will definitely stand to benefit immediately from the day that the repo rate cut starts becoming effective, at least on about 30% of our facilities. On the balance 70% of our floating rate facilities, most of these are either a 1-year MCLR or a 6-month MCLR. So at various points of time, these benefits will come in. It will not come bunched up. It depends on when we have taken the facility and whether it's a 6-month or a 1-year MCLR. But I would say from the day of the rate cut over the course of the next 12 months, we should see a significant benefit coming on at least the 65% of our borrowings.
Got it, sir. Thank you. And so last question that I had is, while I think in last earnings call, you were guiding for credit cost of about 70 to 80 basis points for this year. A related question here is, how are we kind of looking at the provision coverage ratio on stage 2, stage 3? Likely to maintain at similar levels, or there is a thought process that given that collections are improving, cash collections are coming down, non-cash improving, is there an idea to kind of bring down the provisioning cover going ahead? Maybe not just couple of quarters, but maybe over the next 1 or 2 years.
So I think the first point on the credit cost guidance, the guidance still stands at around 70 to 80 basis points. But this quarter, we are reflecting about 61 basis points. It also has a proportion of write-off. So broadly about 30 basis points. We have written off about 7 crores of loan books. So roughly the 60 basis points is spread into 30 and 30, which is incremental provision of about 7 odd crores and of about 9 crores and about the balance coming in from write-off. We will continue to do some technical write-offs purely for tax purposes as well, and given that the regulations permit these technical write-offs. So at this point, we are not changing the guidance on the credit cost. We will continue to be at about 70 to 80 basis points for the foreseeable future. In terms of the provision coverage, we are comfortable, holding this number at this point of time. Our general thumb rule is about 50% provision coverage on stage 3 assets, and the overall provision coverage of 1.5 to 1.6%. We are at about 1.63%. I don't think you will see any significant benefit to come in the short-term future in terms of release of provisions. But if we are seeing, significant improvement in the portfolio, if we are seeing the factors which were used for building overlays are not really, coming out in reality, then we may have to relook at, both the model as well as the overlay, which may probably bring down the provision. But at this point of time, we are not giving you a guidance for any betterment or release of our provisions. We will continue to be broadly at where we are. And given that the P&L has the ability to absorb the provisions that they are creating, why should we refrain from creating some buffers in good days which can take care of us in the rainy days? So I don't think we are going to be aggressive in our provisions. We will be a lot more conservative.
Got it, sir. This is very useful. Congratulations again and all the very best to you.
Yeah, thank you.
Thank you. The next question is from the line of Viral Shah from IIFL Capital. Please go ahead.
Yeah, hi, sir. Thank you. And first of all, congratulations on the milestone. Actually, I have a few questions. One, just from the perspective of quarter, was there any one-off in the other income because we saw a sharp increase on a sequential basis?
So, Viral, you are looking at the non-operating income line?
Correct.
So, see, this will be, other costs like, storage costs and, the fees that we get for the storage costs and all that. So, while you are seeing, a 5 million to a 1.4 million number, this is not a very material number. So, it will broadly be, the storage fees that we collect from the customers for storing their documents, which is typically upfronted.
Got it. And Shrikant, while we are at it, on your previous comment with regards to the PCR, while I understand, of course, the eventual LGDs, especially on stage 3, are not to the extent of what PCR we have, but I believe there is a soft regulatory nudge also to believe of maintaining 50% PCR. Would that be right?
So, Viral, we would have probably guided you otherwise, but we are guiding 50% today because there is a expectation that we also see, because our LGDs are much lower on a very big portion of our lending book. Our LGDs will be probably more closer to about 10 to 12% number. So even a 50% is a far-fetched estimate. But you're right. Yes, there is some bit of a regulatory expectation in terms of maintaining a good cover on the stage 3 assets, which is why we are guiding the market for a 50% PCR.
Got it. And my next question is for Mr. Pati and Ranga. So in this quarter, we have seen that in the rural markets and especially for the MFI borrowers, the collection efficiencies as well as the asset quality has kind of worsened. In that environment, I understand for us also, it was nowhere to the extent of what we have seen. So have you seen some bit of prioritization amongst the borrowers to say repay the secured loans and where they have their house as a mortgage versus the other views that they would have?
So Viral, you are absolutely right. That's the underwriting model that what Five Star took 22 years back. Our underwriting is not for good times. Our underwriting is only for the bad times. So that's why in the last 22 years, Five Star is able to survive all big falls where bigger banks and NBFCs were not able to survive. So you're right in terms of cash flow deterioration in a family. Because Five Star takes the family income and puts all the family members as part of the agreement, there will be a choice of customer whom to pay. So generally, he tends to pay the mortgage loans. That's what you see in HFC, and mortgage lenders like Five Star are not affected when there is a bit of cash flow dent happening. Not permanently, and just for a few months because of the heat wave, elections, and school fees, what I said. Yes, this is a trend that you will see always, and that will not change in the middle class mindset of our country.
Got it. And lastly, in terms of the yields that we have, right? Again, over here also there has been a regulatory nudge for not just MFI lenders but even small ticket lenders. That basically should be some moderation in that, and we have been talking about taking a rate cuts. Any updates on that, and how are you thinking about it going into FY25?
Viral, let me be very clear, maybe crystal clear, that there is no discussion between Five Star and regulators on the pricing front. Right? I think regulators have seen us for the last 5 years, and not a discussion they had or we had with them on the pricing side. It's a market driven, and it's underwriting risk that what the company has that board fixes the pricing. So there is no point on even discussing about that, whether regulator has any concern or not. Regulator has absolutely no concern from Five Star's perspective. So let me be very clear and crystal clear about that. And yes, we have been saying to the market that we'll be passing on our benefits, what we got from the banking side. We were waiting for the rate cut to happen across the world, and especially in our country, but that we are not seeing. But you will see Five Star cutting a bit of rates in this financial year. I can say you it will be around 50 to 75 bits of the rate, because what benefit that we got from the bank the last 2 years, we are happy to say that we'll be passing on to the customer in the due course for the all new customers who are getting logged in Five Star from now to March. So that's the approach that what Five-Star has been taken, and we have been vocal on this. We have been telling from the first con call ever since that we met you that we will be passing on a good rate cut for our customers once the rate cut announcement is there in our country. But it has taken some time, but we want to go first. So you will see a rate cut of 50 to 75 bits in next 9 months to go.
Got it, sir. Very clear. And thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Chandrasekhar Sridhar from Fidelity International. Please go ahead.
Hi, good morning. Few questions. Maybe just on the business growth, Tamil Nadu is now down to about 20% per annum. Maybe just take us through what's happening in Tamil Nadu. I mean, the bulk of the delta is actually coming from Andhra and Telangana. So any particular change? I mean, I can see there is a competitor, NBFC, which is also started off in a fairly large way in this space, a larger NBFC. Just thoughts around that, whether it's, and that's their home market, whether it affects the competitive positioning over there. And MP was basically a market also where we had gotten a foothold, but it's sort of growing it where the company is growing at. Is there any any particular challenges which you faced there? That's question one. Second, two questions for Srikanth. One, I think there was an expectation that the cost of funds would go up marginally because you're diversifying into NCDs and you need to pay up a little more because you're not getting your tenors. It's not going up. So just maybe take us through what's there. And then lastly, we have now crossed 10,000 crores. Will we be having conversations with rating agencies around the ratings upgrades and what is any potential implications on the cost of borrowing? Thank you.
Good morning, Chandra. I'll take the first question. I'll ask Srikanth to come into second, and I'll also comment on the third. Chandra, from the first question, I'll take it up Tamil Nadu, and Ranga will talk about the MP. Nothing has happened in Tamil Nadu, Chandra. We are going as usual in Tamil Nadu. I'm just recollecting what I said in last call or last two calls. Tamil Nadu growth was not catching up with the growth of Andhra and Telangana. They are extremely growing very well. Both from a team perspective, quality of files perspective, supervision team perspective, all were setting very well in combined Andhra, what we call as Andhra and Telangana put together. To that level, Tamil Nadu was not able to catch up. That's the only thing that what we saw Tamil Nadu as a share coming down for Five-Star. But I have told that this year you'll see Tamil Nadu and Karnataka. I've also been saying to the market that Karnataka turnaround story is very good for Five-Star, where we had a bit of slip in COVID and post-COVID, and it was getting corrected, and now they are one of the best performing states for Five-Star. So Tamil Nadu and Karnataka will catch up this year with Andhra and Telangana. So that's the South story. That's where the confidence comes in that we'll be delivering a 30% plus growth in South very comfortably. So I will hand it over to Ranga on a MP perspective.
Sorry, just to is there no competitive intensity being higher impacting in any way?
Chandra, can you come again?
Yeah, just the competitive intensity, do you think it's gone up?
Chandra, I will not say only in Tamil Nadu. Across all states, you see many companies jumping into small business loans, especially after seeing Five-Star success. For 8 quarters, they have been watching us closely, both from a quality as well as profitability perspective. Yes, people are jumping in to do bits here and there. That's the nature of the good business. That doesn't have any big impact in Tamil Nadu. As I said, Tamil Nadu team is not able to catch up the Andhra and Telangana speed. With this year put in place, and I've met all Tamil Nadu guys last month. I'm very confident this year Tamil Nadu will see a good rise comparing to themselves what they were in last year.
Okay. So Chandra, with respect to Central India, I think the challenges are a little bit different. The first thing is in Central India, our ticket size is almost 40% lower than the ticket size that we see in South. So despite that, if we are able to maintain, the proportion of the overall AUM in Central India, it in fact means that, the productivities are higher, but the ticket sizes are lower. On a standalone basis, if you look at NP or MS, I think each of this is growing at about 50% CAGR last year, while the company grew at about 35-36% CAGR. But that said, I think we are very clear and we are investing more in Central India. You will start to see the proportion of Central India slowly going up from here. It is not going to happen in a hurry. We don't want it to happen in a hurry because, these are newer markets. You have to be extremely calibrated with what you have to do. But 100% we are very clear that the markets will go up and there are enough investments that are happening on the ground. Even this quarter, out of the 27 branches that we have opened, 14 branches are put up between Maharashtra, Madhya Pradesh and other Central Indian geographies. So we are very clear and keenly watching and investing in these states, and the proportion will go up.
Chandra, on your question on the cost of funds expectation to go up, first of all, thank you for asking this question because we don't want any of you guys to think that, every quarter we are going to keep dropping our incremental rates. At some point, it definitely has to go up. So, see, the reason it has not gone up during this quarter is a couple of conversations that we've been having with capital markets, especially on mutual funds where the rates tend to be higher, has not completely materialized. Like I said, most of those transactions are expected to happen either in this quarter, which is Q2, or in Q3. So you will definitely see a jump up in the cost of funds in the next quarter. So given that these did not happen last quarter, you probably saw the rate going down from 958 to 949 or so. But definitely the number will inch up once we have capital market transactions coming in. So that is in terms of the cost of funds expectation on the incremental borrowing. See, on the rating discussions, this is something that